Good morning, everyone. It is the Gold, Goats, and Guns live streaming half hour or so. I do these for about 30 minutes as opposed to my Periscopes, which you can find me on Monday nights at 8 o'clock and Friday nights at 9 on Periscope. I usually do about an hour and 15 minutes over there as well. We do these kind of ad hoc. Sometimes I'm on, during the day, sometimes it's the evening, whatever I feel like it. And this morning we've got a lot of things I want to talk about, so I want to get right to it. We're going to show you some charts today for the first time in a while here on YouTube. Got some technical stuff I want to talk about because we've been talking about the hardcore politics and synthetic political discussion, geopolitics and whatnot for the last week or so with all the changes to Trump's cabinet and the news with the British response to the supposed Russian poisoning of a double agent and a variety of other things. So we've got all this hardcore geopolitics and whatnot, and analyzing what does Tillerson's removal mean, what does Gary Cohn's removal mean. All of these things have been going on. It's really been a very interesting 2-week period, and here we are in the Ides of March, and everything is kind of gone. Everything has really kind of gone nuts. But I don't want to focus on that today. I don't want to really talk about that right now. I mean, we can do some Q&A at the end if we want. But what I really want to talk about today is some more technical stuff, because now I want to tie all this back to all this craziness is now starting to have an effect on markets. So let's talk about LIBOR. The LIBOR rate, and I've talked about this a little bit behind the scenes over on our Slack channel for Gold, Goats, and Guns, and I've talked about it a little bit in some of my Periscopes, but I really haven't gone into it in any functional way. I kind of showed you what I'm talking about. I've just kind of made mention of it because it really hasn't been, I would consider, critical up until this moment. Now, Martin Armstrong's got a blog out on this morning. Zero Hedges run some stuff about the LIBOR OIS spread blowing out, the 3-month LIBOR OIS spread blowing out. By the way, you can't get a direct quote for that anymore. Bloomberg put that behind the paywall years ago. And I find it really interesting that nobody else has picked up the mantle to just do the quick calculation and post it and post the data every day. They won't do it. So I find it interesting that they took it offline when the last time when we were going through kind of Greek bailout problems in 2013, and there were some real distress in the markets happening, so they pushed all that stuff behind the paywall. Used to be able to get a lot more free data off of if you go to Bloomberg.com today. It's now almost all of the good data is behind the paywall, meaning you need a $25K per year Bloomberg terminal, or 20 or 25K, whatever the hell it costs. It's way too much money. It's certainly out of my budget. So why is LIBOR important? Why is a rising LIBOR dangerous? LIBOR is the London Interbank offer rate, right? And you can get a LIBOR overnight for overnight rates all the way out to 1 year or 2 years or whatever. What's important is that every loan that is made is based in some way on the LIBOR rate, because this is the rate that the banks offer each other to loan each other money over the course of a certain period of time in order to shore up short-term or near-term liquidity issues. Because in order for the bank to be able to lend you money, it first has to be able to have the reserves to get it, right? It has to have the money, and it can do so in one of two ways. It can get it directly from the Fed, or it can get it from borrowing it from another bank. And the interbank market is effectively the pool of liquidity that's out there in order to fund all manner of lending, right? And banking. This is fundamentally how we go forward, and how this modern economy runs. So LIBOR is very important. So a rising LIBOR rate means that all loans are rising. That means that your mortgage rate's going to rise, and your car loans are going to rise, and all of that stuff. So, but more importantly, it means that a rising rate also means that the banks need a higher premium and a higher payment for letting you borrow money from them. So the banks are charging each other more money to lend to each other because they don't have any money. They need a higher return on their money for lending it to you in order to lend it to you. And so generally speaking, higher rates mean higher risk in the marketplace, therefore a higher interest rate in order to cover the risk. That's what interest is. It's the risk premium for lending you the money over time. It's also paying you for the opportunity cost of not investing the money in some other project. So that's what interest is. This is why the Muslim world is backwards. They don't understand the basic concept of interest, and I fundamentally disagree with that. And you'll note that even in Islamic banking, what they've done is they've just traded kind of equity stake for interest, but in doing so, they also create a much less flexible system, because you have to enshrine in the contract how you're going to pay back the loan and pay back investors, and it's much more restrictive, and maybe in some ways that's good, maybe in some ways that's bad. It all depends honestly on the money units and how they're issued, right? So, and I guess I would say that, just off the top of my head, that flexible, or Western banking would be more flexible in a fully backed cryptocurrency or a 100% reserve system versus in Sharia law, because of the way the contracts would work out, the way the loan contracts themselves would work out, and there would be some fungibility, there'd be some loss due to friction. But the truth is, before I get way too off the beaten track here, the LIBOR rate is rising, and it's rising rapidly. And you guys know that when I do charting, and I don't do this often, and I haven't done it recently, but you do know that I don't look at short-term charts at all. I'm not really interested in short-term charts. I'm really only interested from a political perspective. The only thing that really matters is either a monthly, quarterly, or yearly chart. Anything in the daily or weekly range is really just short-term trading positions. And so I'm going to pop over real quick to the desktop. We're going to move that here, and there we go. So I want to show you, and let's make this big. So this is the monthly chart for the 3-month LIBOR rate. Now I want to go back. Now, when you hear the talk about the LIBOR rate, even Martin Armstrong did this morning, he said, well, a year ago it was 1.2%, or under 1%. Now it's over 2%. But I want you to look more closely than that and see that we're talking about, it rose last summer up to around 1%, and then it traded, and then it broke out. And look at this massive breakout. And we're starting to get into this is almost a parabolic uptrend here. And it's getting very, very, this is starting to look really dangerous. Now, if we back this out and get that's not a weekly chart. Wow. Market Watch, that's terrible. Thank you. So this is a relatively straight linear rise all through 2016, through halfway, and then into the fourth quarter of 2017. But the minute we get to Q4 of 2017, we've now changed slope. At a minimum, this is a much higher sloped line, and potentially the beginnings of a parabolic uptrend in LIBOR. That should worry you. Anytime you start to see a parabolic uptrend in anything, you should be worried. Unless, of course, you're invested, especially in bonds. When you see a parabolic uptrend in rates, that's bad. It's just bad. It's telling you that dollar liquidity is drying up, and the banks are running out of money to lend each other and having to pull back on their interbank lending in order to, and demand a higher return in order to do their business. So I'm worried about this. I'm worried that the OIS spread is starting to break out. I'm worried about some of the other things as well, because this is what's going to precipitate the sovereign debt crisis. Now I want to move over to Europe, because if LIBOR starts to really break out to the upside to any significant degree, and I'm talking, 2% is not terrible. It's not, it's the thing to be starting to be worried about. Now we start talking about 3%, 4%. This could get out of control very, very quickly if there's any kind of liquidity spasm behind the scenes. LIBOR rate and the LIBOR OIS spread breaking higher is telling you that there's a dollar liquidity problem out there, and because of that, we want to be very, very begin to be very worried, because I've been talking about this for a long time, that there's going to be a sovereign debt crisis. Completely agree with Martin Armstrong about this. It's so obvious that Europe's inherent structure is unstable, not just from a political perspective, but from an economic perspective. It's actually, I think, the poor structure of the euro that's actually created all of the political problems that we're seeing in Europe now. It's driven policy. Okay, so we've got two things about Europe this morning. There's two great articles. I've got these linked below in the description to this video that you should read. All three of these articles you should read. The first is from Albert Edwards, talking about Germany's massive current account surplus and trade surplus. Okay, their massive current account surplus is actually indicative of Germany being the world's biggest currency manipulator. Trump goes on and on about China. He goes on and on and on about NAFTA and everything else. But who he's really angry with is the Germans. And it's interesting that he's angry with the Germans. And it's interesting that Albert Edwards brought this up this morning, because I've been saying this for a long time, that Germany is the problem. Martin Armstrong's been banging on this about years that Germany's been the problem. I've talked about how on my periscopes and in other places, I've talked about how the structure of the euro was designed from the ground up to benefit Germany at the expense of everybody else in Europe, because Germany has the strongest economy, and therefore the large is not only the strongest economy and the deepest economy with the biggest comparative advantage in terms of labor and industry and second order and higher order goods and value add and everything else. It's also the largest. It's one thing if you've got a high value add economy like the Swiss, but it's not very big. It's another thing when you're an industrial powerhouse like Germany, right, fourth or fifth largest economy in the world, to be running a 9% of current account surplus against the background of but your currency is tied at the hip to all these weaker countries like Italy and Spain and Portugal and Greece and and everybody else in the Eurozone. What it's doing is it's actually creating a euro that's weaker than the German economy, because if the Germans had the Deutschmark would be trading at $1.60 or $2 or $2.25, but the euro is trading at $1.23. And so this is a massive mercantilist move by Germany. The whole EU is nothing but a big mercantilist nightmare promulgated by the Germans and German industrialists, and foisted on the rest of Germany, first on the rest of Europe, excuse me. And so because of that, now, and it's driven Italy into bankruptcy. It's driven Greece into bankruptcy. It's driven Spain, Portugal, even Ireland, the rest of them into bankruptcy over and over and over again, because they borrowed at rates when they borrowed all this money when the euro was 80 cents. The euro went to $1.60 because of Germany. And the Germans want a stronger currency. They want a stronger euro, but they want a stronger euro they want a euro that's stronger than Italy can afford, but weaker than the German economy actually is. Therefore, they get to raise the protection barriers up around Europe, create Fortress Europe in terms of protection barriers, then scream bloody murder when anybody else, like Trump, calls their bluff and turns around and puts a counter tariff on, which is exactly what Trump did last week with the aluminum and steel tariffs. They were actually not really as much pointed at Canada and Mexico in order to renegotiate NAFTA, which I went over in a post on my blog over goldgoatsandguns.com last week. The next thing, and this is what Albert Edwards was saying this morning, is now he's going to go after Germany. And he is kind of going after Germany. And notice that the minute that he started to talk about steel and aluminum tariffs, they started talking about counter tariffs on American cars. Well, there's already massive tariffs on American imports into the EU. Well, the Germans get to bring over BMWs and at subsidized prices. And notice that they don't really give a shit that they've lost Volkswagen, because they were never serious. They were never serious in the American market about Volkswagen anyway. If they were, they would have actually designed Volkswagens that people wanted to buy. This is why Dieselgate really didn't bother the Germans very much. So this is the situation. And now Merkel, now that she's gotten her coalition together, weak coalition together, her and Macron are now sitting down to a meeting in order to discuss how they're going to rejigger the euro, how they're going to push for stronger interdependence. So, going to be very interesting to see how this goes forward. He exempted Canada and Mexico as part of the NAFTA negotiations. He did, huh? Okay. Well, then these are actually poised straight at Germany. Then he's going after Germany next. He's still going to go after NAFTA renegotiations, without a doubt. But he's got to go after the Germans now. So here you've got Merkel and Macron now wanting to talk about, now we need to integrate all the debt into one structure, which was always the Achilles heel of of the euro in the first place. Now they want to do it. Now that they've pushed this system to its breaking point, now they want to talk about debt consolidation. Now they want to put or organize everything up. Now they want to organize everything around the ECB, which Germany controls. Now they're okay with it. See, it was always the plan, to bankrupt Europe and make them politically weak and dependent upon Germany. And if not, and in the process, buy up all of the good assets all over Europe and make them, and effectively have them owned by Germany, so that the Greek ports are now owned by the Germans. Meanwhile, the Greeks are now screaming for reparations for world. And that's why the Greeks are bringing up reparations for World War II. It's crazy. But Trump is going to blow this up. This is why Gary Cohn quit. Start thinking about this. Trump probably told Cohn flat out, dude, we're going after Europe. We're taking them out. And Goldman is up to its neck in European debt. And he's probably going to he might even go after Goldman from a legal perspective for what they did to Greece. Because that's still not really resolved. All that Greek debt that's out there, that was Goldman, like cooking Greece's books in order to get them into the euro in the first place. Because the Greeks could never have created never have met the EU budgetary targets and debt to GDP targets and everything else, and gold reserves and the rest of it in order to get into the EU. Goldman had to cook Greece's books in order to do it. Now they did it. Now obviously they probably did it for geopolitical purposes in order to keep, because Greece was a NATO member and yada yada yada, and then they wanted them part of the EU, and it was all part of the great globalist plan to create a global world of suck where they win and we get screwed. So that's what's coming. So now the Germans and the French want to talk about this, and the Italians are standing there going, no, we're not doing this. And the Italians, I think, and that's going to be the point that Matteo Salvini, if he becomes premier or prime minister in Italy, is he's going to have to make to the voters. They're going to have to get out of the euro. Now, I saw something the other day which says that numbers that the latest polling results have something like 51% of people would be willing to discuss leaving the euro, have a referendum. That's up from around 30% in the pre-election polling. Now, again, salt all this freaking polling to taste. The numbers are probably in reality, closer to 60%. And if you were to actually ask young people, the numbers are like off the charts, because the young people in Italy understand that they're being fucked in every way imaginable, and they want out. They want out of the euro. They threw all the politicians, establishment politicians out, and they want something better. And they're right. They should have something better. And it means going back to a lira versus the euro that's, trading at 50 cents. Because that's exactly what needs to happen. So that Italy can then turn around and renominate all of its debt in lira, and then pay them all off at a depreciated rate, and actually force the Germans to take a haircut on all these freaking loans. No, what the Germans are going to try and do now, is they're going to open up debt negotiations with the Italians at some point when things get bad, when the LIBOR rate gets to 4 or 5%, and the Italian banking system starts to collapse. Then they're going to try and pull the same freaking deal that they pulled on Greece. Say, well, you don't really have the democratic mandate to go it alone, to leave the euro. So we're going to call your bluff. I got news for you. The Italians aren't going to go for that. They saw what happened to Greece. They know what's coming. They know what the Germans are going to do. I just don't see them. And if they do, then forget it. Then the whole thing collapses. Then the whole EU becomes literally 1984. And the Germans at this point are morphing into Oceania as it's stunning how quickly all of this is happening with the censorship and the rest of it. It's all really ugly. The surveillance state, the censorship, the miserable political fascism that we're seeing. It's crazy. All right, the last thing I wanted to talk about, I guess I talked about all of that stuff. So, and then the last thing I did want to talk about today, so I got into a discussion with Mike Shedlock yesterday on on Twitter. And he was calling out Jim Rickards. I guess Agora is running a promotion for Rickards' new newsletter, saying that Bitcoin's going to collapse to $200 by April. Okay, whatever. If you know anything about the newsletter writing business, and you understand that you have to write ridiculous headlines in order to get people to click on the links, in order to then try and bait and switch them into subscribing to your newsletter. Okay, and I saw this firsthand when I worked for Newsmax. It's just the way the industry works. It's a shitty industry that's built on hype and churn as opposed to building communities. And you'll note that what I'm trying to do here with Gold, Goats, and Guns is to do exactly the opposite of that, is to give you value, drive value, and then almost shame you into giving me money, which I prefer, right? I prefer to provide you with inordinate amounts of value, and then finally when you look at it and go, oh, wow, he's only charging me $12 a month for this? Yeah, okay, fine. And then to build a lifelong relationship with you by being here with you all the time and answering your questions and trying to anticipate your needs and everything else. I'm not always going to do a great job of it, but because who can be great every day? Nobody. But better that, and then build a longer term retention rate than to do the other thing. But regardless of that, so regardless of the editorial stuff, and if you do like what you hear, then please click the link below, subscribe to the channel, and consider signing up over my Patreon to support what I do. All right, so the next thing I talk about, and in this discussion with Mike Shedlock about Bitcoin, he was confused, and I said, well, look, there's no way it'll go to $200. The miners will support it first, which was an off-the-hand comment because I was typing onto my phone. So, Mike, if you're listening, what I really meant was that in a short-term liquidity spasm situation, because I don't believe Bitcoin will drop that far, I could see the miners stepping in and liquidating their altcoins in order to come in and support the price of Bitcoin. That's what I'm really talking about, because a lot of the miners and a lot of the Bitcoin infrastructure, right, has tremendous value. They have tremendous wealth, not just in Bitcoin anymore. They've got Ethereum and Litecoin and Bitcoin Cash and everything else, and they could easily rotate back into Bitcoin at ridiculously low prices, and they will. And that's what I meant. And then and I was talking to Mike, privately behind the scenes about this and a little bit, and it's fine. And I didn't really do a very good job of explaining myself. I want to do a little bit better job of explaining it now. The miners are under no obligation to do so, but it is in their vested interest to try and keep Bitcoin price above the production price. So the production price of a Bitcoin right now is around $2,500. Price is what? In the 8,000s. Yeah, it sucks because it was in 20s, and if you guys, hopefully many of you sold something on the way up, and then even if you got back in at 12 or 13 or whatever, you're still way up over having bought. If you bought last summer, sold somewhere around 15,000, and even if you bought back in at 12, you're still up tremendously. You don't have to, don't cry in your beer over being in a 3 or 4 month bear market after an astounding 15,000% move, right? So, but what will happen over time, and what's more important, and what I brought up to Mike, is like, look, the production cost of gold does not stay, or any commodity does not stay under its extraction price for any length of time. So one of two things have to happen in Bitcoin to get down to $200. All the miners would have to bail on the network, move to something else, and then turn around and have the difficulty collapse down to the point where the production costs of Bitcoins would drop down to $200. Okay, that could happen. I don't consider it high probability. More likely, what I see is that, like everything else, because that's assuming, this is what that's assuming, is that there's no real world use case for Bitcoin. So anybody who's a really hard Bitcoin bear is arguing that there's no real world use case for Bitcoins, that people aren't using them to transact amongst themselves. Now, for the months of like December and January, November, December, and January, when most of the miners hadn't implemented SegWit, and the mempool was the mempool was completely full, and fees were $30. Well, yeah, there was no real world use case other than as a store of wealth against the collapse of the European Union. All right, fine, fair enough. But that state is no longer there. The mempool is clear. SegWit's been implemented by almost everybody, including Coinbase and everybody else, and fees have dropped and the mempool is clear. Huh. So competition, because things like Bitcoin Cash and Litecoin and other things provided competition. So eventually everybody had the people who were trying to restrict the use of Bitcoin in a real world use case, competition came in and ground out the arbitrage, and that was the end of it. It's fine. It's fantastic. So there is a real world use case for Bitcoin or Litecoin or anything else. And therefore, the possibility of it dropping below its production cost, pretty low. Its possibility over time of the arbitrage between the production cost and the current cost, and the current price, that's going to get ground down to zero, because that's what free markets do. And the free markets always do that. That's the hallmark of a free market. Okay. The hallmark of the free market is that eventually Bitcoin miners will make about 4%. Maybe 6%. It's why I love gold, but I'm very skeptical about what gold miners I actually put in the Gold Goats and Guns portfolio, is because I only want stuff where their production costs are dramatically lower than the current price, even if the industry average is 10 to 15, only 8 to 10% above the current price, right? So that the industry average is around 8 to 10%. Production costs are, say, in this market is, say, $1,200, and the price is $1,320, which is approximately where it is today. Larry Kudlow's comments notwithstanding, then that's fine. We're talking $120 over $1,200. Great. It's about 10%, maybe 8%. Maybe it's $1,220, maybe it's $1,180. It's in that range. But if you've got a miner that's producing gold for $500 an ounce, well, that guy's got a massive multiple to any price move, both up and down. It's got tremendous leverage, and it's like a non-expiring option with tremendous leverage, right? Which is still a claim on assets. Fantastic. There are not very many of those in the marketplace. That's what you pay a guy like me to find for you. So, all right. So that's what I've got for this morning. We're at around 27 minutes or so. If anybody's got any questions, you can leave them in the chat. If you like what you hear here, please, again, subscribe. Make sure you make sure you like the videos, because that helps with Google's algorithms and all that stuff. And come on, this is. But I'll post this version of this over on my blog and over on Steemit as well. If you're not following me on my blog, you can do so at goldgoatsandguns.com. You can also follow me on steemit.com, where you can blog, comment, and retweet and repost for Steem, the cryptocurrency. It's trading about $3 right now, $283. I got into Steem when it was trading at 75 cents. And I think Steem is and if you want my honest opinion, I think Steem is a $30 token. But it'll take some time to get there. So build up, and I think, Steem is your path to censorship-proof activity on the internet. And so, absolutely, without a doubt. All right, so you guys take care. You have a great afternoon. We'll talk soon. Keep your stick on the ice.